This conference will now be recorded.
Lovely. So before I start, can you all see the screen?
तो हम सब यहाँ बैठे हैं। मैं आपको अगर ये प्रश्न पूछूं, How many of you want success in all walks of life? आप बात पूछा करें। यहाँ बैठे हैं, आप सबको मैं ये प्रश्न पूछना चाहता हूँ कि आपको जीवन में हर तरह की सिद्धि चाहिए या नहीं? If yes, then raise your hands. सबको चाहिए, लेकिन हमारे लिमिटेशन ये, सोच की मर्यादा ये है कि हम प्रोग्रेस को सक्सेस मान लेते हैं। ये सबसे बड़ी हमारी भूल है जीवन। समझना कई प्रकार की प्रोग्रेस साथ में आती है तब सक्सेस बनती है। Many times of progresses they come together to bring success in life. Success is not just a good business. Success is not just a few relationships well set. Success is not just limited to a good health and joy. ये सब एक वर्टिकल्स है, वो प्रोग्रेस है। और कई प्रकार की ऐसी प्रोग्रेसेस साथ में आती है तब सक्सेस बनता है। इस प्रकार का सक्सेस हमें चाहिए। जब आप 80-90 साल के हो, तब आप अपनी छाती पे हाथ रख के बोल सके कि ये सही ह्यूमन लाइफ, भगवान ने मुझे 70-80 साल का जीवन दिया था, 5-10 प्लस माइनस भगवान की कृपा से, लेकिन वो मैं जिया, इस प्रकार का एक संतोष जीवन के अंत समय में आए, दैट इज योर लाइफ वैल्यू। तो उसके लिए थोड़े विचार और थोड़े अभिगम, और उस विचार और उस अभिगम को बेस बना के, फाउंडेशन बना के कुछ स्पष्ट प्रकार की वर्तणूक भी जीवन में चाहिए। Remember, success never comes overnight. It's one step at a time. मैं कई बार बात करता हूँ कि आप हिमालय के ऊपर, एवरेस्ट के ऊपर हेलीकॉप्टर में जा पहुंचे तो आपका फोटोग्राफ टाइम्स ऑफ इंडिया में नहीं छपेगा। वो कब छपता है? When you go from the base and you walk from the bottom. So success is not an overnight story. It is never a one-day story. तो ये विचार सबसे प्रथम जीवन में स्पष्ट करना है। कई लोग को देखते होंगे, कहीं को मिले भी होंगे, बहुत चंद समय में, थोड़े समय में बहुत आगे बढ़ गए, लेकिन इनके पीछे भी उनका पुरुषार्थ रहता है। कोई सही विचारधारा तो रहती है, कुछ स्पष्ट प्रकार के वर्तन भी देते हैं। तो उसमें प्रथम विचार ये है कि भगवान ने जो हमें ये मनुष्य दे दिया है, उसकी कीमत बहुत बड़ी है। आध्यात्मिक दृष्टि से तो एक अलग बात है, एक स्थूल दृष्टि से आप देखें, अमेरिका में कई साइंटिस्ट इकट्ठे होके अगर ये मनुष्य शरीर लेबोरेटरी में बनाना है, वो भी जीवित नहीं है, मुर्दा, तो ये साइंटिस्ट ने कुछ प्रयोग करके ये बात बताई कि एक मुर्दा ह्यूमन बॉडी अगर बनाना है तो इट विल कॉस्ट अबाउट $5 ट्रिलियन। मिलियन नहीं, बिलियन भी नहीं, $5 ट्रिलियन, वो भी मुर्दा। आप उसके मुंह में आइसक्रीम रखो तो पानी नहीं मिलेगा, आप उसकी प्रशंसा करो तो वो हंसेगा नहीं, आप उसका अपमान करो तो वो मूर्छा नहीं जाएगा। But then human body is $5 trillion. तो एक बड़ी अमानत लेके हम बैठे. If you live for 100 years, अगर आप 100 साल जिए तो ये $5 trillion की कीमत की जो भविष्य थी आपके पास है. Every second is crores of rupees. तो पहले ये सोच करनी है मित्र, एक बहुत अमूल्य चीज हमारे पास है, उसका सही उपयोग हमें करना है. Now the strategy we're going to learn is called the momentum strategy.
Welcome all of y'all. Life is precious. Make the most out of it. Your life is not only yours, it belongs to all the people who have contributed in it. Your parents, your teachers, your family members, your wife, your children, your colleagues, all have a part in it. Your thought and your attitude lays the benchmark. Great. Welcome, friends. Success is balanced, does not come overnight. Right, so here we are. So you remember we did the long straddle, we did the wrong strangle. Market neutral strategy, we do not know the direction, but we're expecting fast movement, right? Selling same strike call, sorry. Then we come from profiting from time decay. Short straddle, same strike call, same strike put. Same underlying, same expiry. Delta should be equal to 0. I think so most of us now have an idea about a short straddle. We have practiced this in and out. We have practiced this in and out, short straddle. How many of you have taken trades on Wednesday, Thursday, Friday? Please, Ramakrishna sir, please clear your confusion. Ramakrishna sir, it was 930 price, not 920. You have to see the 930 price of the spot. Whatever the time you are taking the trade, that time spot price you have to check. If you're taking the Nifty trade at 1235, you have to check what is the price of Nifty at 1235, the spot price. Good. Always remember, yeah, Champak Bhai, shoot your question. In our strategy, the maximum loss is never 22,000. Abhishek sir, if you are following 925 candle every day, you have to do 925 candle. 930 means 930. Our stop loss is 3,500. Champak Bhai, you have not put in the stop loss properly. Instead of points, you have put in percentage. Please change that to points. You cannot do that. So that is the wrong data. If on a single day it is showing 23,000, that was a circuit filter. 23 March was a circuit day. That is why that date is wrong. Remove that. No shift, sir. We will not trail our stop loss. 23rd March 2020 was a circuit filter day. Market open gap down 10%. That is why it is showing 23,000. Remove that day. Our profits will go up. Is it clear? There was a circuit. Shifts are no requirement for trailing. The results are excellent. Right. Any other questions? And if you want to trail, you can trail after 3 o'clock. Shifts, sir, if you want to trail, you can trail after 3 o'clock. Not before that. We should take a position, Siddharth sir, every day, whether it is a gap up or gap down. Every day. We have backtested it. Exact 930 price. Vikesh sir, exact 930. Exactly, I showed you the trade how I did. At 929, I checked the price, and before 930, I took the trade. Is it clear? You were there in the live class. You saw me taking place. That is 930 only, Ramakrishna sir. I took the trade after 929. So between 929 and 930, I took the trade. The reason for taking the trade 1 minute early was at 930, I can place my stop loss. So once I've taken the trade, immediately at 930 candle, I can go and place my stop loss. Shiv sir, the objective is to hold to eat the theta. Have you backtested if you are booked at 2 o'clock? Rajesh sir, stop loss will be the same. Right? It's already there. It's already briefed. Just keep trading. 1235. Right? The results have been shared. Abhishek sir, keep trading. 600 points average. Right? And if you want, you can start trading in July. Why? August. Why? Because from 1st August, the lot size is becoming 50. So right now your risk is more, but from the August month, the risk will come down to 3,500. Great. Lovely. So how many of you would want to do live trading with me with new strategies for 2 days? How many of you are interested? Great. So if you have capital of 4 lakhs and more, and you want to do trading with me on 2 days, be ready. We will select a date. We will get it done in August. Right? Get your capital ready. Try to get 8 lakhs, 6 to 8 lakhs for 2 days, and we will trade. Okay, I'll inform you today. The date is being finalized. By today evening, end of the class, it will be done. So there is an early bird. Make sure we are just planning to take only 150 students, not more, only 150. And be rest assured it will be at very reasonable cost. Some path breaking strategies will come. It will be at the end of August. Market neutral short straddle, selling out of the money call, selling out of the money put. Both call and the put of the same underline, same expiry. Right? Absolutely. Those who come, recording will be available. Short strangle. So what is the difference, Siddharth sir, between a short straddle and short strangle? Yes, Siddharth sir. What is the difference? What is the difference? What is the difference? Siddharth sir, a short straddle is at the money strike. Short strangle out of the money strike. Break-even points are nearer in a short straddle. They are far away in a short strangle. More profits in a straddle than in a strangle. More profits in a straddle than in a strangle. Am I clear? But more investments. Right? Is this clear? I'm talking about long straddle and strangle. So short will be opposite. And you see the break-even points, they're far away. So the probability of a loss in a short strangle is lesser than in a short straddle because the break-even points are far away. But the profit will be lesser in a strangle compared to a straddle. Because the premium collection in a short straddle is more than in a short strangle. Am I clear with this? So the whole idea in a short straddle and a short strangle, it should be in a range. We are not talking about our strategy. We are talking about generally selling short straddle and strangle. So don't confuse short straddle or strangle with our strategy. Our strategy is different. We are talking when we are selling a call and a put both combined and we are not squaring off. If it stays between the strikes, we will make money. Right? Maximum profit is a premium received, maximum loss is unlimited. Am I clear with this? Maximum profit premium received, maximum loss is unlimited. So that is why we need a stop loss. Because if we don't keep a stop loss, we are finished. So you must always know what is the drawback of a strategy. What is the drawback of your trading system? So that you are prepared mentally when the losses come. Delta neutral. What is delta neutral, Ramkrishna sir? Portfolio hedging. What do you mean by this? So if Ramkrishna sir has a portfolio, he has bought a Reliance futures, going up, coming down, loss. Now he feels that there is a possibility of a war, and because of the war, Reliance can come down. So he buys a put of Reliance. So when you buy this one single at the money put, what will be your, have you heard the word hedging? By the word hedging is you limit your loss. So when you buy a put to your existing long position, it is called hedging. But this is not delta neutral. Why? Because can you see this? This is your unlimited loss of your futures is neutralized by the unlimited profit of the put. And it becomes like this. The loss is flat. But this is not delta neutral. One future and one put is at the money is delta positive. So I want to make it delta neutral. What will I do? I will buy one more put. So it will become like this. So any side, if there is a big movement, I will make money. Is it similar to that of a long straddle? Two break-even points far away from each other. Am I clear? Good. Option Greeks gamma. Is the delta clear? Any question in delta? Champak bhai, did you revise? Ashutosh sir, you are revising regularly. Did you do it? Ashutosh sir, did you do your revision? Just put your portfolio. Delta of a future is 1. So delta of an option, put it in the Opstra. Go to the Greeks and check the delta. So if you have taken 3 calls and 2 puts, put everything in the Opstra. And from there, take out the delta of the combined premium. As we do that, delta neutral. Measure of the rate of delta is gamma. 1 point change in spot, 1 point change in futures. That is why the delta of the future is 1. So gamma is nothing but the rate of change of delta for every 1 point increase or decrease in the underlying. What will be my change in delta is called gamma. right? Like delta, gamma, all of you all have gone through the example when Nifty went up to add the money. What happened? The delta increased from 0.4 to 0.5. The gamma was 0.01. You remember the example we did that 0.175 or 0.125. You multiply 70 points into the gamma, you got the change in delta. If not, just see the revision. Like delta, gamma continues to move with the movement of the underlying. Gamma is highest for at the money strike, and it goes on decreasing when it becomes in the money or out of the money. So gamma is highest for at the money strike. Now, gamma with the passage of time, reduction in time value, near at the money strikes, gamma is the most explosive, right? On the last day, gamma near at the money strike is 0.40, highest. That is called gamma hulk. But if you see, when there is more time to expiry, the gamma near at the money strike turns flattish. The curve is steeper as the reduction to time to expiry is happening. And on the last day, near at the money strikes, the gamma is the most explosive. Am I making sense? So gamma is very important on the last day. That is where you have to be very careful as an option seller. You have to be very careful as an option seller, right? Now, what happens when there is high volatility? What happens? There is high premium. What is the premium increase? Time value premium. Intrinsic value will not change until there is no change in underlying. Intrinsic value will not change, right? Now, what happens? When there is an increase in premium, when your option comes towards at the money strikes, when the premiums are higher, the gamma impact near that at the money strike is neutralized to a certain extent by this high premium. So can you see this high volatility? Can you see the gamma near at the money is lower? Can you see this curve? It's just 0.3. This is for at the money near expiry. Now if you see when the volatility is low, can you see the gamma? 0.07. This is 0.03. So on the last day, see after 12 o'clock, 12:30, when the volatility is very low, and from out of the money it becomes at the money, the gamma impact is drastic compared to when volatility is high. Am I making sense? Low premiums, there will be a very sharp move because of the gamma impact. High premiums, the gamma impact is neutralized to a certain extent. Good. Now we come down to the importance of gamma, gamma hulk. Can you see at the money 48, 49, 50, 51, 52. Delta 0.5. Can you see the gamma near at the money strikes we discussed is the highest near at the money strike. This is ITM, this is OTM. Now see your 1 day. Can you see this gamma impact? Can you see the explosion? How many of you saw the gamma impact in Nifty and Bank Nifty this expiry? Bank Nifty 35,500 put was 21 rupees. It closed at 230. Out of money. Right? Out of money. $230. This impact of gamma was there. This impact of gamma was there. Am I making sense? Good. Right, now we come down to theta. Measurement of option time decay. It measures the rate at which the option premium loses time value as it heads towards expiration. Per day loss of time value premium is called theta. It is expressed as a negative number, right? For an option buyer, he pays this option premium. So option buyer loses this time value premium. So it's negative, right? It is expressed as a negative number. As it reflects how much option value will decrease every day. Option seller receives the premium. So he's a beneficiary of the theta premium. Am I clear? Good. So did you notice this? I showed you an example. When there is more time to expiry, the theta value premium is less. But as you are coming closer to the expiry, the per day theta loss increases. And on the last 2 days, the theta loss is the highest because there is no time left towards expiry. There is no time left towards expiry. Am I making sense? Am I clear? Good. The more the time to expiry, the lesser time value premium erosion will take place. The last week will see the biggest fall, and the curve will fall even faster in the last 2 trading sessions. And there is no time value premium remaining because of the completion of the expiry. So we discussed this. If a premium is 85 rupees when the high volatility is there, the theta loss will be higher there. If the premium is 70 rupees, it means that the premium is low. Theta loss will be lower. Whenever there is high volatility, it has higher time value component premium. The theta loss will be higher. The theta loss in the example below will be lower. Is this clear? We discussed this. Any questions? Good. How many of you did not revise? Theta is highest for at the money option. This is the reason why in the live class we were taking at the money option. It will go on decreasing as the option premium move to ITM and OTM. So we saw that highest time value premium. Chintan sir, yes, your probability of survival is more as option buyer in a low premium. Option Greeks rho, rate of which a derivative changes to the risk-free rate of interest. So what will happen to my option premium when there is a change in interest rate is called rho, right? So example, if a portfolio has row 1, for every 1% increase in interest rate, that will be my change in my premium. So what happens? We saw that if the row says that the premium is 1.5, so that means for every 1% increase in interest rate, my call value will go up by 1.5 rupees. And if the put row is 1.2, the put will fall by 1.2 rupees. So if the interest rate comes down by 1%, my call premium will fall by this much amount, my put premium will go up by this much amount. Right? But does interest rate change every day, my friends? Does it increase by 1 or 2%? No. So the rate increase is very minuscule. So the row factor is negligible in our option premium. So most of the time it is ignored. The premium change is so minuscule that it is ignored because the delta and the theta will change, will make the row change insignificant. Is this correct? Are we on the same page? Great. Sudeep sir, did you revise? Sudeep sir, did you revise? Both of all, did you all revise? Good. Good. Who did not revise? Okay. Girish sir, did you not get the recording? So tomorrow I want you all, those people who have not revised, all of you all to come back with revision. And I'll randomly pick up people from the class and I will ask questions. So today is your deadline. I'm already doing the revision with you in the next class, but you need to do it yourself to understand. The reason is now you have become my responsibility. It's not only your identity, my identity is attached with yours. No problem if you don't want to use options in your life, but as a student, it is your duty now to learn options. Why? Because you have enrolled. You are giving your time and your hard-earned money, and there is no exit now. Right? So make sure everyone comes tomorrow with the revision. I will catch anyone. And the person who is not able to answer, God save him tomorrow. There are two types of volatility: historical volatility and implied volatility. What is historical volatility? So just see the definition. Measure of dispersion of returns of a security or a market index over a given period of time. It is calculated by determining average deviation from the average price of the instrument in a given time period. What is the method? Use of standard deviation to calculate the historical volatility. The more volatile, higher will be the historical volatility. I know, friends, this definition is very tough. As a student, I find it difficult. So let's come down to a practical example. How many of you have seen Virendra Sehwag batting? Okay, so he was an explosive batsman, right? So these are his various scores: 100, 80, 0, 30, 140, 55, 85, 25. So what is it? What is the average? 55.96, 1791 was his total score in 32 innings, right? Now what do I do? Basically, now what I do from the average in every innings, how much has he scored more? How much has he scored less? Right? From the average, how much has he scored more? How much has he scored less? I take it out. Right? Once I've taken it out, can you see 50, 100 minus 55? So what am I doing? So let's take, this is the average, 55. So he scored 44 more. He scored 24 more. He scored minus 56. Here is the minus. This is the plus. So can you see this? This is the difference between the average and his actual score. Is this? Can you see this? If I connect this, what can I see? It is the difference between the actual score and the average. Now through the process of standard deviation, this is called the deviation. How much has he scored more? How much has he scored less than the average? When I put in a standard deviation process or method, what do I get? I get this average deviation from the average score. I get the average deviation from the average score. This is what is called as historical volatility. Am I making sense? From the past data, I'm taking out a standard deviation. How much he has moved away from the average. And I assume that in the future, it will do the same. Nothing of that of the moving average, nothing. Measure of static dispersion of returns. So how much has he gone above or below the average, right? Now, let us take this Tata Steel example to understand this process well in the stock market. Let us take this Tata Steel. From 11th of June to the 10th of September 2018, I've got the open, high, low, close. Right? Now I'm taking the percentage close. I'm taking the percentage close. What is the percentage close? The close of today less the close of yesterday divided by yesterday's close in 200. So I've got the percentage close, right? Now once I've got this close, there is a very simple formula in Excel. Can you see this formula? Plus standard deviation, and I'm taking this range of the percentage close of this data. I'm taking this range of this percentage change in the data. Right? Now, what does it tell you, my friends? What does it tell you? What do you understand by this? When it is showing 1.99%, lovely Subramaniam sir, you are engineer. If Tata Steel closing is 600 rupees, the upper band or the upper range as per historical volatility will be what? Very good, 600 plus 2%. $612. This is yesterday's close. If Tata Steel's upper range is 612, what will be the lower range? Lovely. 600 minus 12. So I can find the upper range and the lower range through this formula, taking out the standard deviation. Now, this has a meaning of one standard deviation. What do you mean by one standard deviation? One standard deviation in statistics means there is a 68% chance. There is a 68% chance that tomorrow, this is the range for tomorrow. Daily volatility means tomorrow. Tomorrow, Tata Steel is going to remain between 612 and 588. 68% chance. That is called one standard deviation. Am I clear? Now, what is two standard deviation? Two standard deviation means 2 into daily volatility. That is how much? 24 rupees. 2 into 12 is 24. What will be the upper range? 600 into 20, 600 plus 24. What will be the lower range? 600 minus 24. So 2 standard deviation is 95% probability. The markets are going to remain in this range of 624 and 576. Am I making sense? Now let me come down to 3 standard deviation. What is 3 standard deviation? Daily volatility into 3. So 2 into 3 is 6%. So the close is 600. The next day, 636 and 564. 99% chance the market will stay in this range. Am I making sense? Is this clear? So on the basis of this past data, Siddharth sir, we are taking out this volatility. Right? 600 is the close, 612, 588, 68%. 624, 576, 636, 564. Is this clear? Any questions? Anyone confused? Where is my Rajnikant today? Rohit sir, how are you sir? Pramod bhai, you are my Rajnikant. Clear hua? How is the weather in Singapore? Pramod bhai, सिंपल फॉर्मूला है, आप क्या करेंगे? You will take out percentage close. Percentage close क्या होता है? आज का क्लोज माइनस कल का क्लोज. आज क्या क्लोजिंग था, उसको एक दिन पहले का क्लोजिंग से माइनस करेंगे, डिवाइडेड बाय कल का क्लोज. into 100. ये परसेंटेज क्लोज का फॉर्मूला निकाल लिया। एक्सेल शीट आपके पास है, इसको मैं पूरा नीचे ले लिया। जब मैं एक्सेल में टाइप करूंगा स्टैंडर्ड डेविएशन और ये रेंज दूंगा तो ये मेरे को फॉर्मूला निकल जाए। इसका मतलब है 2% दिखा रहा है। अगर टाटा स्टील का क्लोजिंग 600 रुपया रहेगा तो 600 प्लस 2% माने ऊपर का रेंज हो गया, ऊपर का बैंड। और टाटा स्टील का 12 रुपया नीचे का बैंड हो जाएगा क्लोजिंग से। अगला दिन टाटा स्टील इस रेंज में ट्रेडिंग करेगा 612 and 580. Because sir, you should take a data of 3 to 6 months minimum, right? Historical data of 3 to 6 months minimum you can take for a year also. Similarly, अगर ये one standard deviation हुआ, statistics में 68% of the time ये 612 और 588 रहेगा, right? This is good. Now we come down. Pramod sir, clear हुआ? Yeah, define statistics. These are statistics defined. 9-10 statistics. Now, Pramod sir मेरे को पूछेगा sir, I want the range for 1 year. How will I calculate? Sir, I want to know what Tata Steel is going to do as per the next 1 year chart. Can you see this formula? Daily volatility into square root of 256 equals to annualized volatility. Daily volatility, why are we taking 256? Why are we taking? Lovely working days 256. So square root of 256 is how much? 16. Am I correct? So 16 into 2 is how much? 32. So from 600, if I add 32%, what will I get? Annualized volatility. Right? So 600 plus or into 1.32. 792 and 600 into 1 minus 0.32. 408. So can you see this range? This is the expected 68% probability for the next 1 year. Tata Steel is expected to remain between 792 and 408 for the next 1 year. Am I making sense? Am I clear? Now, my friends, did you see if this daily volatility is 3%, what will happen? The range will go bigger. Will the range go bigger? If the daily volatility reduces, the range will go smaller. Good. Now there are two batsmen, Virendra Sehwag and Cheteshwar Pujara. We saw Virendra Sehwag having very high scores. At the same time, scoring or getting out very early. You have Cheteshwar Pujara, who's absolutely solid, but he does not score very big. At the same time, he does not get out early. he can also have a bigger average or a better average than Virendra Sehwag. So my friends, what is the moral of the story? There are volatile stocks. What are the volatile stocks? IndusInd Bank. They are very volatile. They have higher historical volatility. And you have steady stocks like Hindustan Lever and ITC. So at the end of the year, ITC can give you better returns, annualized returns, than a volatile stock. So please don't confuse yourself with volatility and profitability. Volatility is movement, and profitability is the returns which you will get after a certain period. Am I clear? ITC is a low volatile stock. It can give you a 15% returns. IndusInd Bank is a high volatile stock. In 1 year, ITC can give you 15% returns. And IndusInd Bank, high volatile stock, might just give you 5% returns in 1 year. So profitability is different, volatility is different. We haven't not come down to implied volatility. We'll come right now. We are talking about historical volatility. From the past prices of the data, right? So historical volatility, we discussed about Tata Steel. So this is the range for the next trading day, right? So if the historical volatility is 38% for 1 year, so this will be the range of Tata Steel for the next 1 year. Okay. So now Vikesh sir was saying, how do I find out about historical volatility? Champak bhai, I am not a technical trader, sir. I am a small-time option teacher. If you ask me all those questions, I will faint. Okay, but I will try to answer your question. Can you see Reliance Industries derivatives? I'm opening the stock futures window. Can you see this daily volatility here? Yes? Can you see this? So what does it tell you? If Reliance is closed at 2096 or 2080, sorry. So what will be the upper range? Around 40 rupees, 2120. What will be the lower range? 40 rupees, 2040. %68% of the times Reliance tomorrow is going to stay in this range. Am I clear? 68%. Champak bhai told me. So Ramakrishna sir, they are using the different formula. They might be using 300 days. Right? Everybody uses different formula. Someone uses 320. Square root of 320. Somewhere around that. So we have used 256. That's fine. That's the standard. Is this clear? Now Champak bhai is telling me that what will happen if Reliance trades above 2120. Champak bhai, is that your question? Is that your question? What will happen if Reliance trades above 2120? Now, my friends, we only know that this thing happens about 30% of the times, either above this or below this. So technically, the day Reliance trades above this, it can go up to 2160, 2170. If Reliance sustains above 2120, it might go to 2125, but come down. So if it sustains above 2120, you can see a breakout to 2160, 2170. So you must try to be a buyer after 20-25 minutes of sustaining above this price with a small stop loss. So that day is called a breakout day or a trending day. That will only happen 4 to 5 days in a month, right? 4 to 5 days. So the 4 days this happens is the Reliance result day. The day the Reliance result is announced, that day is a 2 to 3 SD day, 2 standard deviation to a 3 standard deviation day. Please check that out. The day the Reliance result is announced, it is a 2 standard deviation to a 3 standard deviation day. Am I making sense? Champak bhai, did I pass your test? It was a tough question, but only a smart trader can ask those questions. How long have you been in the market, sir? Minimum 2 years. This question can only be asked by someone who has traded for 2 years. Avinash sir, are you there? Yes, sir. Avinash sir, can you see Reliance volatility is only 2%? Now let me take you to IndusInd Bank. Can you see the volatility here? 3.68. So if IndusInd Bank has closed at 1044, what is the upper band? Around 38 rupees. $1082. What will be the lower band? 1002. Can you see the range is much wider than Reliance? So if you're an intraday trader and you are booking profits during the day, you should try to take trades only in those stocks which have a high daily volatility. How many of you are intraday traders? So those stocks where intraday volatility is high, daily volatility is above 3.5, 3%. Your probability of making money is much higher in those stocks than others. Am I making sense? So Anup bhai, is your strategy clear? Short straddle and strangle after the live markets? Good. Vikesh bhai, Make sure that you do not trade in the monthly options. Please don't experiment. Experiment to be done only after you've completed the course. Other rule about short straddle is, whatever strategy you do, you have to do every day. You can't say I will do today, I will not do tomorrow. You can't do that. Discipline. Loss लगेगा तो लगेगा, 3500 रुपया लगेगा तो लगेगा. Am I clear? Any strategy which you decide to follow, follow it religiously and discipline. Whether you're doing Vivek Sir's strategy or you're doing Saurabh Sir's strategy, whichever strategy. Champak by statistics change. If the strategy is it making money on Monday? Yes. Follow it. Follow it. Don't be too emotional. Emotions are man's best enemies. They say Baji Rao would have never lost a battle had it not been for Mastani. Right? So emotions make a person weak. Right? So is this clear? Those people. Srivastav sir, one lot, only one lot. For the next 6 months, you want to practice with one lot. Right? One lot of Bank Nifty, one lot of Nifty. That's good enough. Try to understand the strategy. Yeah, what was the question? Somit sir, how to trade gap up and gap down? Okay. So gap up and gap down. So this is a out of question context. So let me take this. So there is a big gap down. So you have to understand the quantum of the gap down. There's a big gap down. What can happen? After the first 15 minutes, if the market is sustaining below, it can go. But make sure you cut that trade by 12:30. Why? Because if there is a big gap down and the market has fallen too much, after 12:30 there can be a recovery. Right? So there are two things: continuation of a gap down or covering of the gap down. So if the gap down is covered, and then if the market reverses from there, again the markets can come down, or if the market starts trading above the previous day low, it will go up. Right? So there are various ways. Note down the points. First 15 minutes low, gap filling point, 12:30 point, and trading above previous day's low. So these are 4-5 points. Note them. You will get your answers. Have I answered your question, Sumit sir? So it is not a one-way puzzle. There are 4-5 points, and you have to analyze with the passage of time. But you will get your answer. If the market fills a gap and again falls down, it will come down. And if the market has filled the gap and it has reversed, and it is going up above previous day low, you should look a point to buy. So you have to be a spectator. How many of you watch plays, drama? Anyone? Anyone doing theater here? Okay. So have you ever gone to see the rehearsal of a theater? So before they come up with the play, there's rehearsal going on. Okay. So when you see the rehearsal, you see the director is trying to encrypt a script in front of the audience. Right? So when you watch the market, it is something like the theater. When you see the final play, it is what the director is trying to attract you with his words. Same as with the market. There is some big force, institutional, big HNIs. They're trying to influence the markets. You should not sit with a preconceived notion that this is going to happen in the play. No. The job is there are twists and turns and emotions in that play. Similarly, in the markets, it's not going to be a one-sided ride. There will be twists and turns. So as an unemotional person, you must try to understand the twists and turns before making your decision. So one thing what I understood about Sir, Swamit Sir, is having challenges there. He sits on his position. And I struggled with this for a long time. That is why they say you must be in a liquid state to understand the market. Yeah, Sumit sir, I've traveled the journey where you are right now. Right? I can sympathize and empathize with you. The challenges which you are facing. So when you are doing a straddle, the delta change. If the delta is very small, it's going to be a problem. If the delta moves quickly, the big move, you will make money. Theta, enemy. So when you're buying a straddle and nothing happens, 3-4 days, enemy. Right? Same thing with short straddles. Big delta change enemies. If the prices moves in a range, friend. Theta is your friend. Now we'll come down to the last, maybe before that. Let me take you to the distribution curve. What is the distribution curve? How many of you have done statistics or science? How many? Great. Great. Now we are taking, lovely. Lovely. So let's revise it. Now this is the Bank Nifty data from 2019. Open, high, low, close. I'm taking the percentage close. Today's close divided by yesterday's close. Today's close minus yesterday's close divided by yesterday's close into 100. Okay, so this is what is happening every day. How much is the market up or down in percentage terms? Now I want to classify this into ranges. What do you mean by ranges? I want to know how many instances are there where Bank Nifty has closed between 0 and 0.5%. How many days? Okay, so these are the number of days. $70. Right? 70, it has closed and an average, right? So what I'm doing, number of days 0 to 0.570. Now let me check how many times it has closed between 0.5 and less than 1. $66, right? 67. Let me see how many times it has closed between 1% and less than 2%. 66, right? How many times it has closed between 2%? So I'm increasing the range from 2 to 5. 43%. How many times is between 5 and 8? 5 less than 8. Only 5 times. Okay, so I've noted it down. So now let me note that less than 0. Greater than minus 0.5. How many times it is between 0 and minus 0.5? Negative 65. How many times it is between minus 0.5 and greater than minus 1? $56. How many times is between less than minus 1 and greater than minus 2? 49. Right? And 2 and minus 5. Less than minus 2. Greater than minus 5. $43. Right? And less than 5, greater than 8. Five times. Right? This is what it is. This is what it is. Now, can you observe this and tell me? Can you observe this and tell me? What are you seeing? Can you see this number of instances as you are going down? So the close between 1 to 2%, from 2 to 5, from 5 onwards. Can you see the number of percentages are higher, but the number of instances are getting lower? Can you see between 0 to 0.5, 0 to 1, the number of instances are 257. But as it is going far away, can you see greater than 5, less than minus 5? Right. So my friends, when you see this curve and you see the number of instances, it is seen that near the average, there will be a higher number of instances, Nifty will close. But as you start deviating or going further away from the average, the number of instances will get reduced. The number of instances will get reduced. This is seen in a normal distribution. Right? This is seen in normal distribution. Am I making sense? The number of instances will be higher near the average. But as you start deviating from the average, the number of instances are going to get reduced. And this is basically called a bell curve. How many of you have heard this? So we plot the number of instances, the closes between the various ranges. The number of instances the close is within the range is high. As we move towards the far end of the curve, it is noted that the close instances are reduced. This is normal in a normal distribution and it is called a bell curve. So what did we do? You remember 600 Tata Steel, one standard deviation 612, two standard deviation 626, 624, three standard deviation 636, one standard deviation 588, two standard deviation 576, three standard deviation 564. Right? What are we noticing? 68% this range. As you're going far away, the probability is increasing. And at the third time, 99, it is covering almost the entire market move. Is this structure clear? Outside the third standard deviation is called a black swan. So it happens once in 50, 20 years. So if you remember in Nifty, month of March, how many of you were there? 2020. This is called a black swan event. In 20 days, Nifty fell from 12,000 to 8,000, 50%. Similarly happened in 2008. Right? So these general movement of a Nifty in an expiry is 500 points. Right? 400 points to be precise. So 3 standard deviation will be plus 1200 minus 1200. But it fell by 3500 points. So this is a black swan event. Am I clear with this? Good. So this is what is historical volatility and a distribution curve. Right, my friends? 10:48 by my 10. Please take a quick 12 minutes break and come back by 11. We are going to now start implied volatility at 11 o'clock sharp. Right? See you at 11. Welcome back, my friends. How was your break? Good. Lovely. Where is it cloudy, sir? Chimpakba, you're in Bombay or in Bangalore? In Bangalore. Okay, lovely. Implied volatility. Basically, you did historical volatility. What was historical volatility? From the past prices, you took out what was the deviation from the closing price. You were trying to predict the upper and the lower ranges. Now, implied volatility, as we saw that in the options/price.com website. It was inside the price of options. What were you doing? Say 6 days. So volatility 12%. So when you were increasing this volatility, the theoretical price of the option used to go up. When you are decreasing this volatility, the theoretical price comes down. And we know that since the underlying price is not changing, right? So this is a matrix which captures the market view of the changes in a given security price, right? It captures the market view. Friend, sorry, I think so. I was logged out. Can you see my screen? All right. You can see my screen? Good. It is stuck? Okay. So basically what were we discussing? We were discussing implied volatility. Implied volatility is a matrix which captures the market likelihood for the change in price, right? These factors comes from demand and supply. Did you see that when Prime Minister was addressing the nation, we saw uncertainty. So there was a demand. The sellers did not want to sell. The buyers wanted to buy, thinking that there could be a declaration of a war. So the demand for put went up. Yeah, Srivastav sir, don't worry, listen to me. Within a minute, the screen will be okay. So the demand went up. The sellers were reluctant to sell. Because of this increase in demand, there was a higher time value premium. That is why the volatility increases when there is uncertainty. Election results, uncertainty. Everybody wants to be a buyer. So the demand for the call and put both go up. Uncertainty. So when the demand goes up, what do you see? The demand for the call and the put both goes up. Am I making sense? Good. So this IP is calculated from the current price of option. It is inside the current price of option. We saw that. When the IP went up, the option premiums went up. Right? It is a leading indicator. Why is this a leading indicator? Ramakrishna sir, why is IV a leading indicator? IV is a leading indicator. What is the reason? Now when Prime Minister is addressing the nation, did you see immediately the call and the put prices went up? So the option premium went up. Why did it go up? It reflected the change in an event where expectation of a higher price movement would happen because of the Prime Minister's speech. But if I'm seeing the historical volatility graph, can I know it from the past that this Prime Minister came and spoke here? So volatility, implied volatility is sensitive to any changes because of external factors which can bring about the change in underlying price. Historical volatility is nothing but market directional base upper and lower band through the use of past prices. So it is a lagging indicator. It comes only once the data of the past is taken into action. Right? Once the data of the past is taken into action. Am I making sense? Am I clear? Right. Right, let us just wait for a minute. Let's Agnish come in. He has to make me the presenter, then I can show you the screen. Right? Very good. IB is a leading indicator, implied volatility. Historical volatility, lagging indicator. Now once IB goes up, Ramakrishna sir, if IB goes up from 12 to 15, what will happen? Ramakrishna sir, what will happen? Demand and supply, market participation. The premium goes up, Sudeep sir. So if the premium is going up, there is an expectation of a bigger price move either side. High implied volatility results with options with higher premium. So when the premium is going up, it is telling you that the future movement is going to happen either side. So when the IBs are going up, you are expecting bigger movements. When the IB is falling, what are you expecting? Markets to move in a range. So what are these factors which trigger this increase in IB? Sudeep sir, what are these factors? Majorly events. Lovely, Sudeep sir. Sudeep sir, what are the price of tomato? Have you gone and purchased tomato after a technical class? Oh, you're not that Sundeep. Okay. So there are two of us. Okay, so my apologies. Okay, so when the IB moves up, it is an expectation that there is going to be a bigger movement in the underlying price. When the IB comes down, there is an expectation that there is a likely range formation or the movement is going to be slow and steady. The majors, DK sir asked this question, demand and supply are the major factors which are used for determining implied volatility. So when the Prime Minister addresses the nation, there is huge demand. Everybody wants to be a buyer, so IB goes up. Right? After the announcement that Prime Minister announces that India has gone to space, no uncertainty, event over, IBs will fall. Everybody would want to be a seller. Yeah, Rajesh sir, very smart. A seller, if he sells at high volatility, will be a gainer. But the volatility needs to come down after that. Implied volatility increases in bearish markets and decreases when the markets are bullish. Right? It increases when the markets are bearish and decreases when the markets are bullish. Because sir, don't form any view. We are just learning. Okay. IB is determined by the current price of option. Now just see how does the IB determine what is going to be the price movement. Same way, you know, historical volatility you calculated. Same way, IB is annualized. If you see this IB, can you see this IB in this NSE India? Can you see all these IB calculations are there? My friend, this IB is annualized in nature and it is in percentage. So this is 10.57 percentage. 15,800 call IB is 10.5 percentage annualized. What do you mean by this? So let us take this simple example. If a IB of a 200 rupees stock value is 25%, it tells you that there is a 68% chance that this stock will be 200 plus 50, 250, 200 minus 50, that is 150. 250 and 150. You remember we did the same range calculation for Tata Steel? You remember this? 2%. Same way. So when the IV of Nifty is 11% or 10%, it means if the current price of Nifty is 15,500. So you add 1550. So what is the new upper band of Nifty for the next 1 year? 17,050. What is the lower band? Minus 1550. Pramod sir, am I clear? 14,950. Sorry, 14,050. Upper and lower band. Revise करना होगा प्रमोद sir. Ramakrishna sir, I admire you. 13,950. You are good in maths. Lovely. Is this clear? This is one probability, one standard deviation, 68%. So this data which you are seeing, that 68% of the time, market is expected to be in that range. Am I clear? So this IV which you are seeing in the option chain annualized, that is for the next 1 year, and it is in percentage terms, one standard deviation. So if it is annualized, what is the formula did I teach you? Daily volatility into square root of 256. Did I teach you something like this in Excel? Equals to annualized volatility. Yes? So if the annualized volatility is 16, what will be the daily volatility? Square root of 256 plus minus 1. So if I have the annualized volatility, I can take out the daily volatility also. I'm talking about implied volatility. Avinash sir, are we making sense? Are we on the same page? Are we making sense? What is the formula? Daily volatility into square root of 256 equals to annualized volatility. So if I have the annualized volatility, I can get the daily volatility. If I have the daily volatility, I can take out annualized. So your thinking was great, but it is actually annualized in nature, taken for the last 30 days. You are correct. I'll take you to that point. But it is always annualized in nature. Okay. Now, if I have the annualized volatility, what will be the monthly volatility? How many number of days are there in a month? Sorry, how many months are there in a year? 12. So annualized volatility equals to monthly volatility into square root of 12. 12 months. So when I do that, annualized volatility divided by square root of 12 equals to monthly volatility. Am I making sense? Good. Is this clear? How many weeks are there in a year? 52. So annualized volatility equals to weekly volatility into square root of 52. So I can take out any volatility which I want. Any volatility. Are we all on the same page? So now can you see, with the help of implied volatility, you can take out what is the expected range of the underlying, right? Can you take this out? Now let me take you to the option chain. What is the at the money imply premium 90 plus 80. 90 plus 80. Can you see this? At the money call put, how much is it? 170. Right? Now if I add, or if I go here, and I add 170, can I assume it is 1 standard deviation? Somewhere around that. So can I assume that 68%, somewhere around this level, markets are going to stay in this range for the expiry? 2 standard deviation is 340. Vikesh bhai, 3 standard deviation. Right? So when I add the delta of both halves, what do I get? Nearly 0.65. So that is why they say when you do backtest the short straddle, it is seen that on when you do it without a stop loss, 65% of the times you are winning as a writer. 35% of the time you have been winning as a buyer. How many of you have seen that? How many of you have done the stock market backtesting and seen that? When you are buying a short straddle, 35% times you win and 65% time you lose. That means it is staying in this range 65% of the times. Now do you understand the importance of at the money call put? So your range is determined by this. Let me show you this. How many of you have seen this or not? I don't know. So let us sell the 15,700 call. $15,700. Can you see the standard deviation somewhere here? Somewhere here. So it's around 0.60, 0.62, 1 standard deviation near the break-even point. Now, Vikesh bhai, are you understanding? Now it is showing this as 0.55, but please understand, tomorrow when the premium, on Monday when the premium opens lower, this will become 0.65 because this is time value premium and it keeps on reducing every day. So it is assumed that the at the money call put premium is around 1 standard deviation, around 65% of the times. Am I clear? So 65% of the time the market will stay at the break-even points, within the break-even points. 35% of the times it will move outside. When this volatility of the IV will increase, the premiums will go up. So your break-even points will be far away. Is this clear? Rohit sir, you're talking about a YouTuber. How many of you have seen a lot of YouTube videos selling 500 points away, 600 points away, 3 standard deviation? Rohit sir, 5% of the times you will still lose. There is no short strategy, right? So you must know how to control your risk. In the market, the person who is a good risk averse person will make money. Secondly, Ramakrishna sir said premiums are too less. Premiums are too less. Am I clear? Don't try all that adventures. You will lose money and burn. Because now everything what I teach you, you have to use and show me. Right? I have taught you what I know. Now you have to teach me. What is Vega? The Vega of an option is expressed as a change in price of option for 1% change in volatility. Now we went down here to the option chain. We saw these options. We knew that each options have different IVs. Can you see that? Now what is this value of these options? Now let us take this example. Now I'm increasing this IV from 11 to 12. The premium is going up from 110 to 118. How much is this premium going up? For every 1% change we get to know from this Vega. If you see the same strikes, call and put Vega are both the same. When I'm increasing this now from 12 to 13, 1% increase, my premiums will go up by around 8 rupees. Did you see that? My call premium is also going up, my put premium is also going up. For every 1% increase or decrease in this IV, what will be my change in premium? I will come to know through this Vega. I will come to know through this Vega. गामा रोहित भाई मेरा डेल्टा क्या चेंज होगा और एवरी 1 पॉइंट इंक्रीज और डिक्रीज इन निफ्टी उसको गामा बोलते हैं. Am I making sense? Good. It is defined through a calculator. This Vega value will be known through this Black and Scholes calculator. It is defined from there. And it changes every day. Right? Most important, Rajesh bhai, delta and theta. No, IV calculator is maths, pure maths, Champak bhai. So IV becomes more important for an event. When there is an event, their IV becomes very important. Election results, RBI credit policy, right? So what is Vega? You remember the first slide. Rate of change of option premium with regards to change, 1% change in implied volatility. So what will be my increase in my call and put premium if IV goes up? What will be my decrease if IV falls? Right? So when the call premium goes up because of increase in IV, can you see it is going up for all the expiries? So when IV goes up, call premium will go up. Put premium will also go up. Both will go up. Please remember, IV has nothing to do with the market movement. It is an expectation of a market movement. That is why IV goes up. Are we clear? When the IV comes down, call premium will come down. Put premium will also come down. For all expiries, not only for one, for all. Right? Am I making sense? So when IV goes up, call premium goes up, put premium goes up. When IV comes down, call premium will come down, put premium will come down. Right? Yeah, Rohit bhai, you are smart. You are going to come back. Higher IV, we will discuss what is good for what. Right now we are discussing what is IV. So volatility percentage. So this is your premium, this is your volatility. X-axis volatility, Y-axis premium. Now what is India VIX? India VIX is a volatility based index option price. Right? Sir, we will answer that. क्या करना है? अभी तो हम लोग step by step चल. What is India VIX? You see, my friends, the challenge before an option trader is which IV should I consider? There are so many IVs of different strikes. Which IV should I consider? That is the challenge we have. Right? That is the challenge we have. So what does this problem was faced by everyone? So they took out one volatility index. So India VIX is nothing but an index, is a bunch of some IVs of the Nifty monthly index. That is, monthly means the 29th of July expiry. So as we all know that volatility is annualized in nature, right? What is the expected market move for the next 30 days? So every 30 days, this IV expectation changes. What do you mean? That we are seeing that the contract changes every 30 days. From July, the contract will come to August. Are we seeing this? So what is the expectation? Annualized volatility expectation for the next 30 days. Now for this calculation, my friends, there are 5 strikes taken. At the money call, at the money put, right? At the money call, at the money put. 2 strikes in the money. 2 strikes in the money call and put. And 2 strikes out of the money. So what are we taking? At the money strikes, 2 strikes in the money, 2 strikes out of the money. We are taking the IVs of these 10 strikes. 29th of July, monthly expiry, no weekly expiry. And the average of these 10 strikes is your Nifty IV, which is called India VIX. Am I making sense? So let us do this example. CBOE is a company. It's a basically Chicago Board of Exchange, right? They use their method. Let us take this example of calculating. Let us go to the July 29th. Let us go down to the July 29th. Can you see the IV at the money 10? These are the 5 strikes: 10.07, 9.8, 9.99. So IB is 10 average for the call. For the put, what is the average? 13.9, 13.8. Average is 13.7. So the call IB is 10, put is 13.7. So what will be the average IB? 23.7 divided by 2. Around 12. Am I clear? These 5 of call, these 5 of put. At the money, 2 strikes in the money, 2 strikes out of the money. At the money, 2 strikes in the money, 2 strikes out of the money. Monthly expiry. So now we are not confused which strike to select. If I'm seeing the VIX, I know that these 10 strikes averages are there. So remember, till July, till the June, after the June expiry, the July expiry IBs are taken, these 10 strikes. From 15th of July, from July 15th, for the calculation of VIX, you will take the July monthly and August monthly expiries. The same way that you take out the 10 strikes of July, you will take out the 10 strikes of August. And the average of these 20 strikes will be your India VIX. So we know that after 15th of July, this July expiry is going to expire. So what are we doing? We are bringing in the August expiry also. And we are changing. So once the July expiry gets over, your August expiry 10 strikes will be the India VIX. So after the 15th of August, what will happen? The September month will be added. Am I making sense? This is how the VIX calculation is done. So till now, till the 15th of July, only the 10 strikes of July month are taken. After 15th of July, 10 strikes of July, 10 strikes of August. Average till the 29th of July, because that is where the expiry will close. After 29th of July to the 15th of August, only August expiry 10 strikes. From 15th August, you will get August 10 strikes and September 10 strikes. Am I clear with this? Is this clear? Pramod sir, clear? Right. How many of you know there is a chart? Pramod bhai, are you there? Good. Pramod bhai, revise karna hoga. Everyone, can you hear me? Yes, Sukhbir bhai, how are you, sir? I hope I am not boring you, Sukhbir bhai. Do you know that the VIX chart is available? NIF, VIX. How many of you have seen this chart? Good. Now, did I tell you that VIX, when VIX goes up, market falls? Let us now compare. So what will I do? I will go add symbol Nifty. Can you see this? No, VIX is not trading. Earlier there was trading, but not now. Can you see this? When markets are falling, VIX is going up. When VIX is falling, markets are going up. Can you see this? Now, one thing, if you notice, when the markets are falling and the VIX is not falling, what is happening? There is a sharp buying. Did you notice when markets are falling and the VIX is not falling? There is a sharp buying. So if you see before this corona thing, the VIX generally used to stay below 18, 19. This, can you see, this was the election, May 2019. How did the VIX go up? So friends, always remember, during events, market can go up and VIX can go up. This was election. VIX is going up, market is going up. Why? Uncertainty of the election. That is why people are buying call and put. The day the election got over, VIX, can you see a collapse in VIX? The day the election got over, can you see this VIX collapsed? This is called volatility crush. After the event is over, the volatility falls. After the event is over, the volatility falls. So volatility has nothing to do with market movement in an event. In an event, the markets can go up also during results, and VIX can go up. But in normal cases, it has been seen that when the markets falls, the VIX goes up. Can you tell me the reason why this is happening? What is VIX? IV? IV is nothing but a demand for call and put. Yes? What is IV? Demand for call and put. So what happens when the market falls, IV goes up. We know that when the IV is going up, the call IV will also go up. But the call IV will rise slowly than the put IV. The call IV will rise slowly than the put IV. Why will the put IV rise faster? Because there is more demand for puts. There is more demand for puts. So the put IV will rise sharply than the call IV. So IVs of the puts are more than IVs of the call. Am I making sense? IVs of the puts are more than IVs of the call. Did you notice this? So demand for put is more than demand for call. So what happens when market falls? IVs of the put will rise sharply. IVs of the call will also go up. Total IV goes up. Because the demand of the put is more. People want to hedge. People want to speculate. Those people who have bought Reliance futures, they want to buy a Reliance put. So demand for put is going up. IV is going up. No, they are leading indicators. Leading indicators. IV is a leading indicator. When the market rises, the demand for put will fall. Why? Because nobody wants to hedge. So IVs will also fall. IV goes down. IVs of the call will fall lesser than the IVs of the put. Always remember, IV of the put is leading compared to the call. It is more in value and will rise sharply when the market goes down, will fall sharply when the market goes up. IVs of the call will fall lesser than the IVs of the put. In all scenarios, IVs of the put is more than IVs of the call. Only for a certain time, when there is sharp buying in the market, The call writer, when he's squaring of the positions, for that certain period, the IVs of the call can be higher than IVs of the put because of the short covering by the call writers only for certain period of time. Since IV of the put is more, it falls more sharply when the panic is over. Am I making sense now? Why? Only in events, my friends, the IV goes up and the markets can also go up. But once the event is over, please remember, Vikesh sir, you cannot sell IV before the event. The delta risk is very high. Why do people not sell? They know after the event, delta risk is there. If in the election there was a third front government coming, what would have happened? Lower circuit. What would have happened? Lower circuit. Am I making sense? Yes, Subir sir, can you hear me? Am I clear with this? Good. Lovely. So now do you understand in elections what happens? IV is going up. So as an option buyer till the event, I'm getting the benefit of the increase in premium because of uncertainty of the event. I'm getting that benefit. So that is why, do you understand why we make money long straddles during event? Is this clear? Good. Lovely. Any questions till here? Now, let us revise this. No, Ramakrishna sir, uncertainty of the event. Why will a seller write until he does not get a higher premium for taking that uncertainty risk? Uncertainty, no speculation. Sudhanshu sir, uncertainty of budget. If people don't like the budget, it can fall big or rise big. We don't know what can happen. Rajesh sir, you have to use the Gamma Hulk strategy. Use the Gamma Hulk strategy. Right? Yes, IV is annualized. But the option calculator calculates your premium and brings it down to the daily. Right? Absolutely correct, Sukhbir bhai. No, Abhishek sir. IVs go up once the market shows extreme movement. Right? When there is some smart money getting in, that is where IV goes up. When there is, if you see here, IV started going up here after the market broke out. the corona risk became very high, right? That is where the IV started going up. Am I making sense? Right? Any other question? Yash bhai, any IV below 18 is normal bullish. If it starts trading above 18, it is panic. And any IV below 10 is very low. So generally, if the situation is normal, the lower band is 10, upper band is 18 to 20. If it starts trading above 20, then there is some sort of a panic if there is no event. If there is no event. If there is an event, it can always trade above 20. Right? Am I clear? Absolutely correct, Sukhbir bhai, plus minus 12%. Lovely, Sukhbir bhai. The expectation here is plus minus 12%. Lovely. Now you are understanding. It is low. Can you see this IV is low? Now, Vikesh bhai was telling me, what will I do with this IV? How do I play? Vikesh bhai, I have a lot of batches which are going on, which were going on here. So at one point of time, I have about 2 batches in options, right? A lot of my students in March and April were in panic. Markets were coming down. But I told them one thing, markets will not fall. Why? Can you see this? When markets were falling, what was the VIX? Flat. It was not going up. Right? So when markets are falling and VIX is not going up, there is no panic. So what happened? As the market broke out, VIX broke down. Now if you see the market is correcting in a range, but there is no increase in VIX. The VIX has not even gone up to 15. This is a sign of a bull market. This is a sign of a bull market. Now if the VIX goes up above 17, 18, then there will be panic. Am I clear? Above this level, 17 to 18. So if the market is falling, the VIX is not going up, all corrections are buying opportunities. All corrections are buying opportunities. Hope I am clear with it. Everyone on the same page? All the questions are answered? Good. There are some more which are remaining. We will answer that. Now, if the price of the underlying goes up, we all know that if Nifty is going up, if you buy a call option, it goes up. If you bought a put option, it will come down. If Nifty falls, the call option will come down. The put option will go up. Am I clear? Now, Nifty is at 15,700 and you are looking at 16,000 call, 16,000 put. Out of the money call, lower premium. In the money put, higher premium. So when you are buying out of the money call, the premium will be low of that strike, and the same strike in the money, premium will be higher. Right? When the volatility goes up, the call premium will go up, the put premium will go up. When the volatility comes down, the call premium will come down, the put premium will also come down. Time to expiry. If the time to expiry is more, call premium will be higher because time to expiry is more. Put premium will also be higher. When you are coming near to the expiry, call premium will be lower. Put premium will be lower. Are we all on the same page? We all saw that when interest rate was going up, the rho factor, call premium went up, put premium came down. When interest rate comes down, call premium will come down, put premium will go up. Dividend. When a company announces dividend, we know that the cash prices comes down. And the future and the cash will close at that same rate on expiry. So the call premium comes down, put premium will go up. So when the company announces the dividend, call premium will come down, put premium will go up. Is it all clear? Right. Now, Pramod Bhai, your exam starts now. So my first candidate for today's exam is Pramod Bhai. Pramod Bhai is very bullish in the market. He has bought a 15,700 call. 29th of July expiry. $186. On Monday evening, Nifty closes 100 points up. Monday. What is the date on Monday? What is the date? 13th or 12th? 12th. What will be his premium? IV falls by 1%. IV minus 1% गिरता है. না না দুবার বন্ধ হয়ে গেছে। Yeah, can you hear me? All of you? Good. So today you guys are hoping that I'm boring you and you want to go early. Looks like my go-to meeting is getting closed time and again. Right. So Pramod bhai, Nifty goes up by 100 points. What will be my premium on Monday evening on the 12th? So can you see the screen? The delta is 0.4252. So Pramod bhai, for every 1 point increase in premium, what will be my delta telling me? What is it telling you? For every 1 point increase, Pramod bhai, 50 paisa. For every 100 points, what will it be? 52 rupees. Yes. So my delta is 52. My option premium goes up by 52 rupees. Now Pramod bhai, theta is minus 4.5. 1 day loss is 4.6. What will be the 3 day loss? 4.6 into 3. What is it? 14 rupees. Why? Because as an option buyer, I will lose premium Saturday, Sunday, Monday. 14 rupees because it will keep going up every day. Now, what did I say? My IV comes down by 1%. So what will happen to my option premium, Pramod bhai? बढ़ेगा कि घटेगा? IV बढ़ता है तो कॉल पुट का प्रीमियम बढ़ता है, IV घटता है तो क्या होगा? घटेगा, it will come down 14.3. So what is the net impact? That is why I have done minus. Pramod bhai is a buyer. Can you see theta is in minus? Pramod bhai is a buyer. So minus hoga. So 52 minus 14 minus 14 is how much? 28 is how much? 24. So Pramod bhai, what will be your new premium? 186 plus 24. 210. Now what is this gamma? Rate of change of delta. So for every 1 point, 0.0009, for every 100 points, what will your gamma be? 0.09. So what is your old delta? 0.52. What will be your new delta? 0.52 plus. So this is in percentage. So it will be 0.09. So it is 0.61. Am I making sense? No, Ramakrishna sir. This is in percentage, 4 digits. So 100 it will be 0.09. It is here. This is Vega. For every 1% drop, my Vega amount will come down by this much. For every 1% increase in IV, it will go up. Now, my friends, this is exactly what the option calculator does. Did you notice that? exactly this will do. Let us put this. What was the sum? 15,710 future price, right? What did sir buy? Sorry, 15,700 call, right? What are the days to expiry? Today is, what is today? 10. So 29th, how much is remaining? 19. Interest rate 6.5. Volatility 11, right? The premium is 185. Now what are we doing? Now days to remaining, Monday 16 remaining. Nifty has gone up to 15,810, right? IB has come down to 10. Can you see this? Did roughly we get that same value, Pramod sir? Roughly same value. So these Greeks tell you each and every impact, delta, gamma, vega, theta, rho. What is your change in option premium with regards to change in the various inputs? Am I making sense? Good. Pramod sir, you have passed the exam today. Sushanto da, are you there? Dada achen apni. Sushanto da. Because sir, we are doing that example. Option seller, we are doing that. Dada, we have to do this. Vikesh sir wants this example. Sushanto da, you are bearish. You have sold the current expiry 15 July, 15,800 call. You have sold. 15,800 call. Nifty falls by 100 points. Nifty 100 পয়েন্ট সোমবারে পড়ে গেছে সুশান্ত দা। What will be your new premium? Yes, Sushant da. Yes. So what is the delta? Minus 0.3. So that if Nifty falls, I will be a gainer. Yes, because the delta is in minus. So the premium will fall by 33 rupees. So what is the premium remaining? Only 18. Right? IB goes up by 4% to 16.3. IB goes up. We have seen this when the market falls, IB goes up. Sushantoda, is it clear? Is this clear? So when the market falls, I will receive the premium. For every 1.5 fall, 33 points. Option buyer loses, option seller gains. Is this clear, Vikesh sir? Can you see the theta? It is plus. 3 দিনে theta কত হবে? Sushantoda. 1 day 8 rupees. Saturday, Sunday, Monday. What will be the theta? 24 rupees. Yes or no? Good. Vega, IB goes up by 4%. IV goes up by 4%. So what is the Vega? When you are option writer, can you see when IV goes up, you will lose 27 rupees. So Champak bhai, this is minus. Why? Because IV has gone up. As a writer, when the premium goes up, I have to lose. I lose money. Did you notice this? As a writer, when premium goes up, you lose money. Is this making sense? Am I clear? Ramakrishna sir, when the IV goes up, what happens? There is an increase in the premium value. Who gains? Buyer. So when you are a seller, you will lose. So it is minus. So seller is opposite. Buyer loses theta, seller gains theta. So when the markets are going down, you are gaining. So what is the net impact? 33 rupees, 24 rupees, minus 27. So how much will the premium fall by? 30 rupees. So what will be the premium? 90. So we need to practice this now. I know you can get the premium through the option calculator. Simple. 33 rupees delta gain. Theta gain is 24. Vega loss is 27. Add all the three. Each and every one has to be calculated separately. Delta, I gained 33 rupees. Why? Because Nifty fell, I sold the call. I made 33. Theta, 24. So for every 1% fall, 6.7. IV went up by 4%. So 6.7 into 4, 27. Am I clear? Champak bhai, is this clear? Oh, this IV percentage is decided by the market, right? If the market falls very quickly, Vikesh sir, IV can go up by 10% also. Good. There is a news of India-Pakistan bombing going on. IV will go up very quickly. Great. Any questions? Vikesh sir, did you understand now? So this is your calculation. You must know how to calculate. That is important. Because this is the reason why we are learning Greeks. The reason for learning Greeks is I want to know what will be my premium if the underlying goes up on Tuesday or on Wednesday. I can get it through the calculator. So Champak bhai, IV chart gives you a basic value. It can go up. It is dynamic. Market conditions, IV will change. Demand and supply. Yeah, that is your last question. We are going to come. But did you understand how IV is calculated? Is this clear? Sukhbir sir, you are going to do the next one. Sukhbir sir, 15,800 put. Let us come, Vikesh sir, you are very excited. In market, we have to be patient. Patient is a hallmark of a good trader. 15,800 put. Right? Sukhbir sir, you have bought. On Monday, Nifty falls by 200 points. IV goes up from 10 to 13.79, 4%. IV percentile goes up by 4%. What is your new premium? What will be your new delta? Yes, Sukhbir sir. So what is going to be delta if the market falls? Delta is minus, I will gain. Right? So how much will I gain? For every 1.71 paisa. For every 200 points, how much? Lovely Sukhbir bhai, 142. What is your theta loss? Sukhbir bhai, 3 days, right? Saturday, Sunday, Monday. 18, minus 18, Champak bhai, don't write 18. It is minus 18. You don't gain in theta. You are losing. Vega, will you gain or lose? IV is going up. Vega, will you gain or lose? Vega, will you gain or lose? Gain, how much, Sukhbir bhai? 25, 6.25 into 4. Is it 25? So delta gain 142. Theta loss minus 18. Vega gain plus 25. Roughly round number. So what is your net change? 149. What is your premium? 284. Am I clear? Great. So now all of you are clear how this premium is determined. What will be your new delta? New delta 0.0019. So 100 points 0.19. 200 points 0.38. Am I clear? So 0.71 minus 0.38. So the delta is 0.99. Deep in the money option. So if Nifty falls by 200 points on Monday, deep in the money. Am I making sense? Is this clear? Good. Now we come down to the last part which answers Vikesh sir's question. How do I come to know whether the current IV is cheap or expensive? What do I do with it? So there are two methods, my friends, to know whether the current IV is cheap or expensive. Method number one, IV rank. IV rank tells us what is the current IV compared to the past IV. IV rank is equal to current IV minus 52-week low divided by 52-week high less 52-week low, right? Into 100. So let us take this example. Let us go down to the current price. What is the lowest IV? Around 10. 52-week high IV in the month of June, 34. So 34 minus 10 is 24. What is the current IV? 12. 12 minus 10 is 13 is the current IV. 13 minus 10 is equal to 3. So 3 divided by 24 into 100. Right? So IV rank is somewhere around 12.5. So what is the IV rank telling you? That the current IV is near to the low part of the 52-week high-low IV. Am I making sense? But what is the problem with the IV rank? Can anyone tell me? So options are cheap. What is it telling you? Options are cheap. So if the IVs are near to the low IVs, that means options are cheap. If the IVs are near to the high IVs, what does it tell you? Low volatility. Options are expensive. Anand sir, what is the problem with IV rank? Can you see this data here? Can you see how many days it was at 80? Very few days. Can you see how many days it was near to the lows? Very few days. Right? So these are outliners. These are outliners. So IV rank gives you outliner data. It's not a very reliable indicator. IB rank is not a very reliable indicator. So what do? We have to find one more indicator, which is called the IB percentile. How many of you have kids in the house? Okay, the report cards, have you checked? IB percentile is a percentage number of days over the past 1 year or a particular time period. Your IV is under the current IV. That means if your son has got 90 percentile, that means 90% of the students are below him. Right? 90% of the students are below him. That is IV percentile. So you can do any data calculation, 6 months or 1 year. So when IV percentile is greater than 80, it means that the options are expensive. That means from the past data, the current IV is greater than past data 80% of the times. That means options are expensive. Options selling strategy needs to be used. Right? When the IV percentile is 20 and below, like presently, can you see that the IVs are near to the lows? It means that the options are cheap and buying strategies can be used. Now is this clear? So what is the rule of the IV? So Vikesh sir, is your question answered? 0 to 20 IV percentile, options are cheap. Buy naked options. 20 to 40 options are relatively cheap. IV percentile 20 to 40. buy option strategies. We will do that from tomorrow. 40 to 60. IVs are neutral. You can use both buy and sell strategies. 60 and 80 options are moderately expensive selling strategies. 80 to 100 options are very expensive selling options. Please understand, during events, the IVs will be always near this. So the events are an exception. Events are an exception. Very good, Ashutosh sir. I am glad you asked this question. How many times have you seen here? Did you see this? We were doing this since a long time. Did you notice all this? Lot size 75. Let me take you to Bank Nifty. What is the IV percentile? Did you see this? So the IVs are very low. Let us do Adani Ports. Let us do Apollo Hospitals. So let me take you to another site. This is called Quansup. How many of you have seen this site? Great, Sobit sir. Oh, I showed you. So nice, Vikesh sir. I forgotten I had shown you. Can you see this VIX? This is the VIX and the Indian price chart, which I showed you, right? Okay, so this IV they have changed. Okay, so this IV probably they have changed to professional. So this is now no longer free, right? This is no longer free. It's simple. IV chart, to take out the IV percentile. If the IV percentile is low, option buying. Right? So these are for pros. They actually made it for pros. Okay, so pro means you have to pay. Right? No problem. I'm going to take you. So here you in Quansup you get this, but you could get the chart also there. Right? Now the important thing is, Vikesh bhai, ऐसा कमाना है तो कुछ खर्चा भी करना होगा. Nothing comes free in life. Right? So they also have a cost. So did you understand this? This is when we are going to decide the strategies. Now you remember something? Yeah, the OPSA will show, no doubt. But I wanted to show you the chart also. The value is fine. I wanted to show you the chart. Did you remember there was something called short straddle? The last slide of the short straddle. When you are an option seller, you want the IVs to be high, and then IV should decrease. Higher the IV, the better the premium received by the short seller, the more will be the gain. Right? More will be the gain. Is this clear? So as an option writer, I will make more money when the IVs are high. As an option buyer, I will make more money when the IV is low. So now can you relate all this? Can you relate this? Gamma, low volatility, gamma explosion is higher. So Vikesh bhai, you will use after the event, not before the event. So now you got the answer. Once the event is over, the volatility will fall. Wait for the event to be over. No, Avinash sir, selling or buying is later on. You have to use the option, right? So after 15-20 minutes, the budget gets over. What do you know? That now the IV will fall. After 2 hours, it's over. That is why I told you, you must see the election webinar. You will understand what happens after the elections. Right? Wow. Stay hungry, stay foolish. My friends, now did you understand what is the purpose of Greeks? Why this is very important? Because if you don't know what is the premium change happening, you will never be able to make money. Right? Friends, the good news has come. The date of the live session has already been announced. It is end of August. Right? Only for 200 people. So only serious traders who want to basically earn money out of trading can join the live session. Right? I have sent you all the link in the WhatsApp. The link has been sent. You can see that. So in the live session, I will be trading with some new strategies I'm already backtesting. The fee should be reasonable. I have told it to keep it below 2,500 for the students for 3 days. It will be a 2-day live market along with theoretical. So there will be some pioneering concepts which I'm backtesting right now. Different. So we hope to recover the fees in the live market. I told you 4 lakhs is good. Anywhere between 6 to 8 lakhs, lovely. Right? Great. Thank you, friends. So by that time, I'm hoping all you guys who are doing short straddles will be having the funds to make it to join. That is not important. Important thing is right now focus. Focus on what we have in hands. Only after the program, if you feel that you want to be a full-time trader, then come for the live class. Am I clear with this? So right now, focus in your course. Learn to make money with the short straddle strategies taught to you. And after 15-20 days, you can decide. There is no point deciding earlier. Clear? Thank you all. As they say in life, markets and life give you a second chance. Markets and life give you a second chance only if you are ready to change. If you are ready to change, be the change what you want. Full revision. Tomorrow you're going to have an exam. All the best. See you tomorrow morning.